we operate 16 data centers across 4 continents, and the majority of the load that we operate, the compute that we operate, is Bitcoin mining. And when we mine Bitcoin, the Bitcoin that we receive for doing that, we keep. And so that essentially we recognize as revenues. But we're in the process of beginning our transition and expansion into Inference AI, which will be a growing portion of the workloads that we deploy. We also are a vertically integrated technology company and energy company. We own energy assets. We own wind farms. We generate energy off of flare gas and oil fields. We're able to develop, co-develop technologies around ASICs, software orchestration layers. So we're a technology company that's very focused on maximizing the value of every electron we can get, and we help energy companies take excess energy and turn it into profits.
What's going to lead you to profitability?
Well, a combination of things. One is obviously the Bitcoin that we hold on the balance sheet is constantly marked to market, but more importantly, as Bitcoin continues to be accumulated by institutions, you mentioned it in your kind of preamble as you're talking about, BlackRock's Bitcoin ETF having garnered bigger fees than the S&P 500 fund. There's a huge amount of institutional interest in Bitcoin. There are a number of Bitcoin Treasury companies springing up every day, and you're seeing an accumulation of Bitcoin, which is driving the price up. We're almost at record highs again. And as that continues to move upwards, it helps us generate considerable margins. The thing with our business, similar to the AI business, and I think you're going to find this if you look at any AI company that operates large data centers, is there's a huge CapEx investment up front in building these sites, and the profitability comes over time once the equipment has been depreciated. We depreciate our equipment over 3 years, and unlike our peers, we have the ability energy mining off of flare gas. We're able to essentially move our ASICs that have been depreciated to these low-cost marginal cost energy sites, and that drives much higher profitability and also better capital utilization.
I'm sure you've been following the back and forth between Jim Chanos and Michael Saylor. It's been really entertaining. But, MicroStrategy stock is up even more than yours. I think like 3,000 or 4,000% in the past 5 years. And these kind of leveraged, Bitcoin holding companies are popping up all over the place. What do you make of that? Because those companies don't really do anything else besides, sell shares and borrow in order to buy Bitcoin.
So, the model with Bitcoin Treasury companies and the model that, Michael Saylor has optimized is essentially buy Bitcoin, issue equity, and as the price and value of the Bitcoin that you have continues to go up, it drives your equity price up. And if you can raise capital at a higher price than Bitcoin, then your Bitcoin yield per share goes up, which is very attractive. The problem is what happens if Bitcoin price stays flat or starts to go down. You said his stock was up over a 5-year basis by a huge amount, which is true. But if you look from year to date at its performance compared to the Bitcoin miners, even, you're starting to see that performance is running into headwinds. In theory, a Bitcoin Treasury company's price should increase by upwards of 2 times whatever Bitcoin's price is increasing on a daily basis because of the leverage that they're driving. And that's not the case anymore. I think what we're starting to see is the saturation of the Bitcoin Treasury business market, because to your point, they're not in any other business. They're taking over a company with a marginally profitable business, and they're turning it into an accumulator for Bitcoin. And at the end of the day, you have a bunch of people competing for capital, and that capital is going to go to the highest return, which means the lowest multiple to NAV. And over time, that multiple to NAV is eventually going to go to 0, not unlike what happened with Grayscale, where for a long period of time, the Grayscale Trust, which held Bitcoin, was trading at a discount to its NAV. And I think there's risk, especially as you layer a lot of debt on these companies. If Bitcoin goes down by any considerable amount or stagnates for any length of time, there could be challenges for them to maintain that multiple.
You know, you're borrowing against Bitcoin as well. Obviously, you have other businesses that you're running. You mentioned the 16 data centers, the energy generation, inferencing, which is, I agree, going to be absolutely monstrous, but it's still risky. How do you manage those risks?
Well, we follow very much a capital allocation model where we look at our average weighted cost of capital, and then we look at the types of investments that we're making to see that we're ensuring that we have, are above a certain hurdle rate across a variety of places. And if you think about our business, we were basically 5 people and a few miners 4 years ago, and today we're the largest in the world at what we do. And we're also the second largest holder of Bitcoin in the world of corporate entities. And so I think we have built a very strong balance sheet. We've built the ability to execute. We're the only company of the publicly traded miners that has the geographic distribution that we have, and that has the kind of breadth of business that we have. And I think that's going to pay off very much, not just in the near term, but the long term, as Bitcoin becomes more and more of an institutional asset. Bitcoin data centers start becoming more and more integrated into energy transformation plays with data centers. The grid has a huge need for flexible baseload, which is essentially a type of compute that can turn on and turn off as needed by the grid. You guys saw with the heat bubble that happened in the Northeast, the grid was strained. Yet in Texas, they didn't have those issues. Why? Because in Texas, they have a large amount of Bitcoin mining on the grid where the grid operator can tell them, hey, shut off, I need the energy. And Bitcoin miners comply and shut off. If you had more Bitcoin mining across the grids in this country, especially the grids that are heavily loaded, you would not see the challenges that you have today, such as in PJM and other ISOs, where consumers are being impacted by increasing prices of energy because AI loads, which are not flexible, are coming online, and they're getting more and more strain on their grids. So we play a very unique role in helping balance grids and helping make grids more flexible. And I think what you're going to start seeing is embracing and a bit of a marriage between AI data centers, Bitcoin mining, and how the two can work together to optimize grids and make sure that there's plenty of available energy for consumers. If you wanted to do some research, Duke University did a study about 4 months ago on this topic that showed that there's more than enough energy on the U.S. grid to support flexible loads if they could flex 0.25%, which is a quarter of a percent. And we flex upwards of 30-40%. So we're clearly an answer to that problem.
Let me just ask you though, on this, and you talked about the hot weather and that Texas, managing it, but how has the hot weather increased the energy costs when it comes to Bitcoin mining and for all miners so far this summer?
Well, most of our sites in the U.S. operate in Texas, also Nebraska, North Dakota, Ohio, amongst other places. And so the northern regions don't sit on grids where you have really that challenge. In Texas, you've had a lot of hot weather, and you've had a lot of what's called curtailment, which is when the grid operators contact us and say, hey, we need you to shut off. And so the impact to Bitcoin miners is that we essentially don't operate, so we're not generating revenues those days. But the benefit to us is that we get lower priced energy because of that. And providing that flexibility to the grid in Texas allows the Texas grid to not have to buy extra energy that is very expensive. If you think about the energy markets, base load is kind of the energy that runs all day long. It has a fixed price. And then you have this variable or intermittent energy. Wind and solar farms create a problem for grids because the wind doesn't blow at a constant rate for a constant number of hours every day, neither does the sun. And so they're dealing with balancing this variable intermittent generation from solar and wind. And at the same time, demand is different all day long. So you need to match the two.
I totally get that. Just quickly, I know Matt wants to also ask something, but I want to ask you a quickie. Are you looking for other areas of the U.S. or even the world when it comes to new Bitcoin mines?
Yes, absolutely. We have a stated objective that 50% of our revenue will come from outside the U.S. by 2028, and we're quite a ways along in building a pipeline of opportunities across places in the Middle East and Europe where we believe we'll be able to meet that goal quite handily.
I would be happy in the great state of Ohio, and not need to go anywhere else. Go Buckeyes. Fred, I want to ask quickly about, you have developed new technology for inferencing, including a proprietary two-phase immersion cooling technology, which I think is really neat. And but the thing is, with inferencing, you don't need nearly the power that you need for training, right? And I wonder about the hardware that you're using, because NVIDIA chips are obviously very expensive and maybe overkill for inferencing. Have you said, or are you working with other chip makers to get your gear?
Yeah, absolutely. So the inferencing is very similar to Bitcoin mining in that you're constantly chasing an efficiency curve. In the world of inference, it's lowest cost per token. And obviously in AI, a token is not what it is in the crypto world. But a token is a measurement of a certain amount of compute. And so there's this constant need to lower the cost of token. As AI gets more intelligent, as there's more reasoning in AI, the cost to do a query, an inference, becomes more expensive in the number of tokens that it takes. And the single biggest challenge that if you talk to enterprise customers, they'll tell you, the price per token is too high. We need a lower cost per token. And at the same time, they need to ensure that they can get access to very rapid responses. So these data centers have to be in close proximity to the customers, and the energy costs have to be low. So we've been working with people all the way down the cost curve, all the way down to ASICs, as we look at inference as a way to lower the cost. And we totally predict that there'll be a very extreme cost decline over the next 2 to 3 years in inferencing as new technologies come in place, so that you won't have to use this huge infrastructure that you have for learning. One of the biggest challenges today is that a data center builder needs to get a payback on all that investment in under a year, because the technology in their data centers is obsolete after a year. Just look at what NVIDIA is releasing in the way of technologies.